Welcome back to part 2 of this Fin Bites video. This part concentrates on the big picture interactions of standards and some of the details in IAS 8. Going back to our earlier timeline from part 1, we've already discussed how events A and B fall under IAS 10 requirements. Event C is a bit different. It occurs after the financial statements have been authorised for issue. Let's look at a couple of possibilities for Event C. Our entity from earlier discussions may have decided in October to sell one of its subsidiaries. In this case, Event C would be outside the scope of IAS 10. On the other hand, Event C might be that during October a large stocktake error was discovered. This materially affects the balance of inventory at the 30th of June 2000X8. What should the entity do? As the financial statements are already authorised for issue, it isn't an IAS 10 requirement. A material stocktake error would be caught under IAS 8. If we'd found it prior to the date that the financial statements were authorised for issue, it would be an adjusting event and it would be sorted out under IAS 10. But once they are authorised for issue, it becomes a prior period error and is adjusted under IAS 8. Note here that if you're going on to the Audit and Assurance module, the auditor responsibilities might be a bit different to the financial reporting ones. This image here is trying to demonstrate some of the common interactions of accounting standards that you could encounter in a professional context or a CA program exam. Practical scenarios often involve multiple standards at once, so part of your professional competence is understanding these interactions. Try to think about these possible interactions as you study a unit. Imagining what else a scenario could involve will help you to be better prepared for professional practice. Now let's take a quick look at IAS 8 accounting policies, changes in accounting estimates and errors. Accounting policies are the specific principles, bases, conventions, rules and practices applied by an entity. Am I measuring this financial instrument at fair value through profit and loss or amortized cost? A good way to think about accounting policies is to think clear-cut choices, method A or method B. Supporting these policy choices, we start to step into the realm of accounting estimates. Lots of estimates go into our measurement decisions: useful lives, impairment levels, estimated losses, inputs into valuation processes, levels of provisions. An estimate involves reassessing a carrying amount of assets or liabilities. They are not mistakes and they are not errors. They are responding to new information or changing circumstances. Prior period errors are not about reassessing an estimate. They are about financial statements that have already been issued. Errors are actual mistakes. They arise when the entity has failed to use the reliable information they already had when the financial statements were authorised for issue. They also arise when you should have had the information but didn't. Errors could include just being unable to add or not applying the accounting policies that you said you were going to apply. Errors could also include fraud. Here we can see an extract from the definitions in IAS 8 for accounting policies and for a change in accounting estimate. It is really important to distinguish between policies and estimates and between estimates and errors because they are accounted for differently. For policy changes and also for errors, we go back in time and change the comparatives. We also tax affect these changes under IAS 12. The exception to the requirement to turn back time is where changing the past information is impracticable. The standard talks about what impracticable means in the paragraph 5 definitions. Changes to estimates are the only one that is forward-looking. When we change an accounting estimate, we don't worry about the past numbers.
Here we have a bit of a visual to help you think about what is occurring in the entity as we apply these different accounting standards. The choice of accounting policy usually falls under a particular standard, and IAS 8 tells us to look at that relevant or particular standard. For example, when we're accounting for intangible assets under IAS 38, there are often estimates supporting an accounting policy choice. Then IAS 8 kicks in if we decide to change those estimates or change that accounting policy. Time moves on and we prepare our financial statements at year end. But before we authorise the financial statements for issue, we are on the lookout for events after balance date under IAS 10. The financial statements are authorised for issue, and later, after the issue, we may find a prior period error, and we deal with that under IAS 8. We hope this quick recap on IAS 10 and IAS 8 has helped your understanding. Don't forget to go through your candidate study guide for more information and post on the discussion forum if you have any more questions for us. Thanks for listening.